Okay, peeps, welcome back. So today we're going to be going over the market macro for July of 2024. So with that being said, let's get it. Okay, so it is hot as hell here. Excuse my language, but we're going to go ahead and get into the macro for July of 2024. We're going to talk about the indices, oil, inflation, stuff like that. So let's get into the content. So we'll get into the charts, but we're going to get into the outliers first. Okay. So first thing I want to point out here is that we have CPI coming up this next week. As you guys know, CPI is one of the major indicators that the Fed looks at in terms of determining whether they're going to cut rates or raise rates or keep rates the same. In my opinion, cuts are coming in September. I think the Fed is going to do whatever is most beneficial to both investors and the economy, if you ask me. And if that means just simply a 25 basis point cut instead of a 50 or a 75, well, so be it. So with that being said, what we're looking at here for core inflation is basically a 0.1 percentage point reduction on core. You can see from basically the prior 3.3, they're estimating 3.2. And year over year headline inflation, they're estimating from 3 to 2.9. The thing, if I'm not mistaken, I believe the thing that the Fed actually looks at is core PCE. So let me see if I can actually find that for y'all. Let's see, core PCE inflation. I don't know if they're actually going to have it here. Okay, so I'm not really sure if any of these are it, but we'll go over that in a future video. But that's pretty much what they look at, if I'm not mistaken, for inflation. So I believe if last time I checked, core PCE inflation was at 2.5%, so pretty close to the 2% goal for the Fed's target. I mean, regardless, the headline and the core inflation is basically pretty much almost at 2%. So I don't see any reason, in my opinion, for the Fed to wait. So fear and greed index here, you guys can see even after the crazy flash crash we just had, we're still sitting in extreme fear. So the markets are a little trepid about what happened. Even I have to admit, when we looked at our portfolio, we were just like, oh my God, what the hell is going on here? It was like a redux of 2020. The difference is we were just simply index investors back then. We had just gotten into crypto right after the 40% drop during the pandemic. So obviously our investing perspective has changed between then and now, but regardless, it was, I'm not going to lie, it was a little bit scary. So I'm not really surprised the markets are still a little bit fearful here. But again, this is the time to buy. We are still buying. We're still buying dividend-paying stocks and ETFs and crypto. So let's go over the Fed watch tool here. So basically we have over a month until the next Fed meeting. Of course, CPI comes out this month, and I believe another one is going to come out before the next FOMC meeting. So we'll have two. Let's actually look at that here. So yeah, September 11th. So you got the next FOMC meeting on the 18th of September. So yeah, two more CPIs before the Fed has their next meeting, which in my mind pretty much guarantees a cut of some kind next month. So you can see the markets. This is constantly changing. Just so y'all know, the markets are kind of in a toss-up right now between 25 basis points and 50 basis points. Before it was sitting at 50. The majority of expectations were at 50. Now it's kind of slated towards 25. Regardless, any cut would be better than none. I mean, we've been sitting at flat, 5.25 on the Fed funds rate for eons at this point. I think everybody's desiring some kind of relief here. So November, you can see basically it jumps to the potential of 2 quarter basis point cuts. There is a possibility here for 3, although it's relatively small. And going into the end of year, December, we're pretty much looking at this point, it looks like roughly somewhere between 75 to 100 basis points, with the possibility of 125 and a very, very small chance at this point of 150 in cuts by the end of the year. Of course, you guys know that will change by the end of the year because these things are always changing. So CPI, again, it comes out this week, August 14th. That is at 5:30 a.m. Pacific Standard Time, 8:30 a.m. Eastern Standard Time. And of course, if you're interested in this and you trade and stuff like that, you trade in the markets, not just invest. Just adjust your time accordingly, according to where you're at. So that's going to be on Wednesday morning. Okay, so let's go ahead and get into the charts. So the thing I want to show you guys is, markets think that there is going to be some kind of sell-off, and we do have some kind of bull flag here. Okay, this is on the daily time frame, but there is some correlation between these previous events that I want to show you guys. Okay, so we had 3 instances here. Okay, 3 instances, and I am literally not kidding you. Oversold in October 2023, oversold in April 2024, and oversold in August of 2024, which was the Japan carry trade that we just saw, the flash crash. Every single time this happened, the market went up. Okay. So in October 2023, basically to that peak, you saw a 27% run from the April one to the previous peak. I'm going to do that. So you basically saw roughly about a 14% run. And the question is, how much is this going to be? But it is what it is. Oversold, oversold, oversold. We hit a bottom, we hit a bottom, we hit a bottom. That's pretty much it. And I showed you guys a lot of the single stocks on X, like Nvidia, Coinbase, MicroStrategy, so on, Tesla. It's all lining up perfectly on the single stock level and on the indices level. So basically what I'm expecting here, this is a bull flag. A lot of bears are going to look at this and be like, oh yeah, we're going to short the markets. We're going to dump this thing to zero, right? And whatever. And I hate to say it, but the charts just don't support that. I mean, look, we get a bull flag, and then what does it do? It breaks out to the upside, goes up. Get a bull flag, breaks out to the upside, goes up. Get a bull flag. In theory, we should be breaking to the upside on the oversold signal here. So in terms of, well, we can take a look. Actually, I can show you guys on the Fibonacci here what the potential levels would be looking like. So the next level that we could potentially be looking at is basically, I literally can't make this stuff up. The 1.618, which is the next major Fibonacci level on the daily time frame, is 6,000 on the S&P. What did I tell you guys? By the end of the year, I expect the S&P to be somewhere between 5,800 to 6,000. Tom Lee, he said, I forget what exactly, 57, 5,800, something like that. So we're pretty much in agreement on that. So the other thing I want to show you here is that each time we did get a bounce on the daily time frame, the RSI was not quite oversold on the weekly, but it doesn't really matter because, again, even though it went into oversold on the weekly, it did actually still go higher on the indexes. And I want to show you guys this from back in 2021. You can see that we were overbought on the indices on the S&P for basically an entire year, actually longer than a year, without a major correction. Basically, we were just kind of sitting at 70, 80 for like 12 to 15 months, just still kept going up. And then the Fed said they came out and threatened us with their rate hikes. And then, the rest is history. You guys know what happened after that. So in terms of a pullback level, I think that pretty much we already hit the bottom of wherever this pullback is going to be. I don't think it's going to be lower than what it currently is right now. Because if I draw a line straight across from where we currently sit, you can see that this basically is a flip zone, okay? So we had a lot of support here, then it kind of turned into resistance, then it turned back into support and went higher. Now we're retesting, going back up from this support area. And this pretty much, it basically just pretty much went back to about May. So we retraced 3-4 months worth of price action in literally 4 weeks. And once again, like I said, each one of these sell-offs have become progressively shorter. So you had 98 days, and then you had, what was this? That's maybe a little short. So we'll go from the peak here, basically the peak down to the bottom. So you had roughly about 28 days, and then you have, so I think this may be roughly about the same amount of time. So 28 days, roughly about the same amount of time. But this one was much larger. That's the point I want to make. The larger the move down, the faster it happens, the faster, generally speaking, the recovery, which is why I think we're not going to have a sell-off in September. So that's the S&P. Again, major support is right here in the zone. This is going to be 4,600 to 4,800. Even if we did have a pullback, which I really highly doubt we're going to have, I don't think it goes lower than that. Again, I think the pullback's over. I want to make that clear. So NASDAQ, I'm actually not going to go over so much the weekly time frame on this one. So the NASDAQ, basically the same story, okay? So we hit a support zone here, hit oversold, boom, we bounced, hit the top of the support zone and this channel here, or this rising broadening wedge here, and hit oversold on the RSI, and then bounced. And then, yeah, we didn't quite hit a support zone here, but I mean, whatever the case, it doesn't necessarily have to be on support. The point is that the RSI was oversold and we pretty much immediately bounced. I mean, that's what we've seen the last 2 times this has happened, so I'm expecting that to continue. Again, 16,000 to 16,800 in my mind would be the absolute bottom. If I were to measure this for a Fibonacci retracement, you guys can see the next 1.618 level is all the way up at almost 23,000. Again, I do think that's possible by the end of the year, especially with the crazy sell-off we had. So Russell 2000, nothing new here. Basically just came back and retested the support that we were already testing. That's not really a shock. So pretty much just kind of still sitting within this huge channel here. That's basically 1950 to about 2130. Didn't quite hit oversold on the daily time frame, but again, the Russell 2000 could run into the end of the year. 2 new all-time highs, especially with Fed rate cuts, because they have the most benefit, being the smallest market cap companies, from the cheap borrowing costs. So yeah, I'm thinking Russell's probably going to go higher. I think it's pretty much already hit its bottom, which is this major support right around that $2,000 or 2,000 point level. Again, the highs are up here in this zone, roughly about 2460, which is a major move up. I mean, that's another 18% just on the index. So Dow Jones, this one actually has held up very well in comparison to the others. I'm actually kind of surprised it even got outside of this channel, but as you guys can see on the daily, it pretty much came back to this previous low back here on the RSI, which is also coincidentally almost exactly the low on the price back in May, for a potential double bottom and then a bounce. Same thing on the NASDAQ, kind of this double bottom right here, double bottom, and then bounce. That's a bullish pattern, just so y'all know. So again, absolute bottom, worst case scenario, 35,700 to 37,200. I'm not even going to measure it because I don't think it's going to happen, but that's, worst case scenario, which again, after a 17% drop on the NASDAQ and the market sold out for 3.5 weeks straight, I don't think that's likely to happen. So 43,150 is what we're looking at on the Dow Jones. Okay, let's get to stocks above 50 and 200. So you can see the 50-day average here on the NASDAQ. We didn't quite get to oversold territory, but got pretty close. Again, generally speaking, the closer we get to the green zone here, the better the buying opportunity in the short to midterm, close to the red zone, better selling opportunity or taking profits in the short to midterm. We got down to a 29, which again, this ranges from 0 to 100. So a 29 to a 30 is pretty cheap in my opinion. So S&P, this one's a little bit different. As you guys know, S&P is not so tech heavy, so there's not as much volatility here. We're kind of sitting in the middle, no man's land. It's above the 50, which is basically pretty much swing trade on for swing traders. Swing traders do look at this. We look at this and basically just say, okay, if it's above 50, swing trades are good to go. If it's below 50, hands off on the swing trades on basically just strictly stocks. But it looks like we pretty much bottomed out right around the previous areas we bottomed out, pretty much had about a 40. So again, this green zone down here, basically between 0 to 15 is the perfect buying opportunity, and 88 to 100 is pretty much more or less the perfect selling opportunity. Okay, so NASDAQ stocks on the 200, you guys can see we kind of had this double bottom here on the 200 version for the NASDAQ at roughly about a 40. Again, definitely expecting this to bounce and go higher again. Just to show you guys how rare this is more of an investor's chart, whereas the 50-day is more of like a swing trader slash like a cyclical seasonality kind of trader chart. This is more for the long-term investor. You can see over the last 4 years, or 6 years, my bad, we've only ever gotten to the extreme buy zone 4 times. So it's definitely a good chart to keep an eye on. I'd still say swing trades are on for the mid to long term, and I don't really see the markets, especially the NASDAQ, going any lower since they were already massively oversold to begin with. S&P a little bit more stable than the NASDAQ. You guys can see on the 200-day here. I really got to go back pretty far to show you this. So 1, 2, 3, 4 times only, we have actually seen the extreme buy zone get hit. That was during the Fed, basically, I believe, hiking rates back here in 2018. The Fed cutting rates for the pandemic in 2020 and the bear market lows in 2022. That was literally the only time that you would have had to buy at the absolute lowest lows. That was pretty much it, 4 times in the last 6 years. So we pretty much just hit a double bottom here, same thing as the other charts. I am expecting this to still go up. I'm expecting the indices to still go up. So pretty much almost oversold here on the RSI. Again, the lows of this thing would have been the perfect opportunity to buy. So the uninversion of the yield curve, basically you guys can see we're roughly about 10 percentage points away. When this thing does fully uninvert, that would be when the Fed starts cutting rates. That's when we need to start paying attention. Again, the uninversion of the yield curve it has had some mixed results. It hasn't always necessarily led to a sell-off. The bias is kind of that it does, but based on what I've seen, that's not entirely true. It is kind of mixed. It's like the SOM rule. The SOM rule doesn't necessarily always lead to a recession, but it is just kind of an early warning sign to watch out for. So we'll have to keep a close eye out on that one. Again, you can see the uninversion of the yield curve is a bad thing, but in reality, the cost of borrowing goes down. Money comes out of savings accounts and the likes and goes back into risk on assets, which means risk on assets theoretically should go up, right? Stocks and crypto. So I don't think it's necessarily a bad thing. I think it's something that a lot of investors and traders are actually looking forward to. Okay, so unemployment rate. We talked about this before. It is slowly going up. Again, we did have a golden cross on the RSI and the MACD. That's not something we want to see. But I mean, not every time that this thing has had a golden cross has it gone to such extremes. It is a little concerning, I won't lie. Okay, but not every single time did it go to crazy highs. You guys can see basically, it kind of went up a little bit in 2001 and then came down, went back to pretty much, a little bit higher than where we're at right now, but didn't really get an extreme pop until 2008. Kind of similar here. So 69 went up, then came down a little bit, but then it was still relatively low at 5%. Went up, came down a little bit, and we didn't get the extreme pop until 83, and then it eventually came down. Very similar story throughout history. So not every single time this is triggered has it meant absolute catastrophe. It's just kind of depends on the situation, I guess. Earnings were very good this season, so I don't really foresee this as being like a doom and gloom situation. But I do think it's something we need to keep an eye out on. Okay, so next here we're going to take a look at oil. So let's look at oil. As you guys know, oil is inflationary. I am fully expecting Trump to get elected, and that will basically bring an end to the conflict overseas because, as you guys know, Trump is a master of doing that, which means that oil prices theoretically should come down and the last of the oil inflation should be pretty much put to bed. Because when oil goes up, that is inflationary, and that's obviously not a good thing. So potential, in terms of technicals, potential double bottom here on oil. You guys can see we got one bounce and another bounce. It's possible maybe it heads all the way back up here to 87 if this is to be some kind of W pattern. So support here is at 62 to about 76, 90 to 94.80 on the resistance there. We did nearly hit oversold. As you guys know, it usually does have a bounce when that happens. Anything technical has a bounce when that happens. We are potentially about to have a golden cross as well. So at the very least, it may come up to roughly about this 87 level on a potential short-term W pattern playing out to the upside. The other thing I want to point out here is if we get some kind of break of this trend line, obviously that would equal oil prices skyrocketing to the moon. But again, I don't really see that happening because the Fed would not be cutting rates if they thought that some kind of extenuating circumstances was going to keep inflation higher for longer. Okay, so let's take a look at the precious metals. So we're going to start with gold. I know a lot of people love this one. I will say that on the gold chart, we are hitting all-time highs here on the price, but also on the RSI. So in my mind, I think there is actually going to be a short-term pullback on gold. I know a lot of people don't want to hear that, but we really never tested this green box here as support. So it's possible that may happen, especially when the Fed starts cutting rates and it becomes more evident that there's not going to be a recession, not like people think it is. You guys got to remember, precious metals are a safe haven, okay? They're basically a hedge against economic collapse, a hedge against inflation, okay? It's a protection of wealth. So if people realize that, oh, everything is going to be fine, we don't necessarily need to keep our money in precious metals, we can go back into stocks, right? They're going to do that because they're going to get a greater return on stocks, and these are going to come down in price. Okay, so we're looking at 1800 to 2100 on support, 2520 at resistance. I would not touch this with a 10-foot pole. If I was going to buy gold, I would be very sparingly about what I bought. Maybe tenth of an ounces at a time, because this is like crazy expensive compared to even the support area. So if it gets a drop to support at roughly about 1800 and then pops back up to retest the highs at some point later, that's about a 41% gain. Silver, this is one that I personally like a lot. I really, really like silver a lot. Just so you all know, you may not know this about me, but I actually used to be a silver collector, silver stacker, as it were. I didn't really have a lot, like some of these channels out here that you see, but I did have a decent amount because it's relatively affordable compared to gold. And also, in addition to that, I don't know, just something about it. The little shiny metal is very attractive to me. So, anyways, it looks like silver might be hitting a peak here on the RSI. Again, we're kind of getting this this little tweezer top here that could indicate a pullback of some kind if we're looking for a pullback into a certain area. Since we're still kind of within this little sideways channel, I would suspect it's probably going to come back to 20. The best buying opportunity, in my opinion, is $8.60 to $14 an ounce. But if it comes back to 20, in my mind, that is actually still a buy, if I'm being completely honest. So resistance here at 29.35 to 36. So if it gets a pullback, moves up to resistance, 74% gain. Just so you all know, when we do head to the coin shop to go buy precious metals, usually what we wait for is we'll wait for a major hit of these support levels to get in on the cheap. Usually that could take like a few months, a few weeks, or even a couple of years. And then we just go load the boat. It's one way to do it. Some people just stack. They don't really care about the price. So palladium, it's sitting at a perfect support level. You can see resistance turn support here. This is going on over a decade. So it's going to be about $900. And then the all-time high up there at roughly about 3,000. So the risk reward here, in my opinion, is absolutely insane. So 220% gain on palladium. Platinum's still relatively cheap too, although not as cheap as I would like to see. So the support here is 770 to about 830. Resistance 1700 to 1920, somewhere in there. And again, people that buy precious metals, they usually look at this as a long-term hold. So it's not like we'd be looking to flip it overnight. So 131% gain here. Copper, so we are getting some kind of double top here. There's a potential for a pullback. Maybe it pulls back into roughly about $3 a coin here, or an ounce, I should say. $3.15, somewhere in there. You can see this top here that then got flipped into support and retested and went higher. The ultimate buy zone is down here at $1.25 to $2 an ounce, and then $4.10 to $5.10 per ounce to the upside. So potentially maximum 67% pullback and 22% short-term pullback here. So we'd be looking at roughly about 60% gain from the short-term pullback, and then long-term pullback roughly about 280% gain. And again, these plays on precious metals, the way that we do it could take, it could take months or years to play out. We just usually look at these from time to time because it's such a long-term time frame, and it's kind of a more of a long-term investor kind of perspective. Okay, so we looked at Fear and Greed Index. We're not going to do Bitcoin because that is a separate video. We will take a look at the DXY though. And also the VIX. Actually, I think we'll do the VIX first. So basically, the fact that the VIX went all the way up to 65 here and then pulled back and closed it at 20 tells me that likely the low that we saw for stocks is in, and we are going to go higher, and potentially the same with crypto as well. So because if we were really truly going to get some kind of serious like 20, 30, 40% dump, this thing would have stayed elevated up here, but it did not. It closed the month, or I should say the week out, the month out, or basically on the monthly at this point. It's at a 20 is what I mean to say. So you can see that basically we closed the week here on this candle at a 20. And this is a very bearish candle with a very long wick to the upside, which tells me that likely the move to the downside is pretty much done. So DXY, the important thing I will say about this is in terms of stocks and especially crypto, we want to see a breakdown of the DXY. That usually is when Bitcoin goes up. So when the DXY kind of makes a move like this, you can see March 2020, that was the pandemic, right? And then Bitcoin went to all-time highs right around December of 2020. What happened with the dollar? The dollar was at the all-time lows when Bitcoin went to highs. And when the dollar went back up, that's when Bitcoin went down in price, okay? So a decrease in the dollar index equals a pump in the price of Bitcoin and crypto, and an increase in the dollar index equals a drop in the price of Bitcoin and crypto. That's what we're looking at. And the flip side of this is the $6 trillion in money markets and money market cash equivalents. The dollar index will come down when that money comes out and goes back into risk on assets looking for a better return on their investment. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.